I really believe that 2023 was one of these things where it was FOMO to the hilt. And then you had yields rally, meaning went up in October. People freaked out that it was just this big head fake move. And then the market took off again when yields reversed. That's what the whole big thing was. Then you had the melt up at the end of the year and a follow through into this year. All this is right now, I believe, on a near-term basis, is you have a Janet Jackson type market. What have you done for me lately?
On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. A very warm welcome to the On the Tape podcast. That was Dan Nathan moving his risk reversal flask.
We got swag.
It's really nice, actually. It's one of those water bottles.
It's a Yeti.
Excuse me? Isn't that the thing that people see like out in Anchorage, the Yetis? Or is that something different?
You could do.
You could, right?
Yeah.
There's a lot.
You could also see Russia from there.
I've read that, actually. I heard that.
I'm just saying.
We have a great podcast today. By the way, this is the On the Tape podcast. Guy Adami, Dan Nathan, Danny Moses, and Parts Unknown right now.
No, he already did it on the Tape podcast with Vincent Daniel and Porter Collins.
Where can you find that, Dan?
In your favorite podcast store. It's actually in the feed right now. So if you're listening to this, you probably already listened to that, but you haven't. Go back and listen to it because that was straight fire, as the kids say, Guy.
Fire emoji.
Yeah.
Joining us today is Brian Belski. He's the chief investment strategist at BMO Capital. People just say BMO.
BMO.
So we're going to talk to Brian. And on the back half of this thing, we're going to talk to TV's Melissa Lee. You know her from CNBC's Fast Money.
As do you.
She also just did a documentary. We call that a doc called Big Shot.
The Ozempic Revolution.
Which was really actually
a great doc.
I thought it was her 6th documentary. Apparently, it's her 10th.
Yeah.
So prolific.
Yeah.
We both thought of that word.
Are we just finishing? That's what we're doing right now, Brian Belski.
So we got Brian Belski here.
We're just finishing each other's sentences
together too long.
But before we even start with Brian, I just want to say to you, I loved you in Rounders. You were unbelievable.
Wait, is it Damon? What is he? I know you're going Malkovich. Is that what you're doing?
And that's.
Are you doing the Malkovich thing?
That's a
Have
huge
you heard
compliment.
that before?
Oh, yes.
Really?
I have.
It's a huge
I
compliment.
loved you in Rounders.
Well, first of all, it's an amazing.
First of all, if you ever met Matt Damon, that's probably one of the first things you would say is, I loved you in Rounders.
I did love him in Rounders. Yeah. I actually, not that anybody particularly cares, but I think it was 2001-ish. Okay. I was walking in Lower Manhattan, and there's a museum of, I think, Native American history down there.
Okay.
And I was walking, and a bunch of limousines came up, and in one limousine, Winona Ryder gets out. I'm like, holy shit, that's Winona Ryder. And because I had a crush on Winona Ryder back then.
Still do, sounds like.
10 minutes later, Matt Damon limo. They were dating at the time.
Oh, wow.
A lot of people don't remember that. I don't know what made me think. Oh, because you brought it up.
The Rounders.
Anyway, Brian Belski, the last time he was with us was March of last year. Now, Brian, my first question to you, and I want to get into your career, what your thoughts are on the market, all different things, but this is how I want to start. If one has been the least bit bearish since the fall, one has been wrong. I have been more than the least bit. I have been extraordinarily bearish, which makes me more than wrong. That's French.
Yes.
Please tell me, without calling me a complete asshole, what have I missed? What has been the glaring thing that has sort of like levitated this market? And by the way, a market that you thought correctly would be at levels that we're seeing now.
Yeah, well, thanks so much. Frankly, I think you got into the trap of being too fucking macro like everybody else. I mean, did I say that in my inside voice?
You're right.
And I think that the issue is we're going to make the market call. We're going to think, here's the market and the S&P 500 and the earnings and the PE. I'm just saying that voice because it's stupid. But we've forgotten that the stock market's a market of stocks. And I've stood by my discipline and process by saying I really believe that this is the quintessential stock pickers market. What really bothers the shit out of me is that now everyone's saying what we were saying 14, 15, 16 months ago, which scares me shitless. And we can talk about, our near-term views, but we're still very, very bullish. But I think because the macro stuff didn't work, it worked so well in 2022 for you, brother, right? And it worked really well in the fourth quarter of 2018. You go back to that and you're like, holy shit, we didn't have a recession. Where is it? Holy shit, the Fed's going to get this wrong. You can't not think like that if you're wired like that. So I don't blame you. I don't blame the bears. I blame some of the bears that have become so excessively narcissistic. I just don't get it. I don't get it. I think it's because we have the very good fortune of actually running money. So we put our money where our mouth is. And frankly, and very humbly, we lost people money in 2022 and it drove me fucking crazy.
Yeah.
But when you sit across the table from someone that's been with you for X amount of years, 10 plus years, and they say, we're sticking with you, Brian, that's massively, incredibly humbling. And I think that's where the macro people got it wrong.
Yeah, it's interesting you say, now I'm going to get a little off topic, but it's interesting you say we're sticking with you, because what you learn in our world in a number of different verticals is, one would think that performance is the be-all, end-all of everything. If your performance sucks, people leave. But what you come to realize that if you have a relationship with people and if people trust you, performance makes its way down to number 3 and number 4. So what you just said there, that we're sticking with you, Brian, through that what probably was a difficult year.
Yep.
The reason why is because you have a relationship and there's a trust in you that you've established over a period of time. You're not just a hired gun or a mercenary that people are just looking to flip.
Well, I think it's the instant gratification society.
Yes.
I think we all have complex PTSD post-COVID. I mean, yesterday in New York, you're walking around in the rain, right? You're walking around in the rain and you have your umbrella, one hand on your umbrella, one hand on your phone.
Yeah.
How are you supposed? I mean, we need shit right away.
Mm-hmm.
No. This is you nailed it. I think that there's been a whole generation of investors that only believe you buy stocks because interest rates go down. But now there's been an entire generation of investors that don't know how to use the phone.
Mm-hmm.
Pick up the phone and call someone. There's this little device on the phone called voicemail. Leave a voicemail. I mean, we've forgotten how to speak. We've forgotten how to write. And I think it's because we were locked in rooms and now all we do is IM and we talk to our hedge fund clients on.
That's
I
right.
mean, we've forgotten how to do that. So if you're the other way in your old school, Frank the Tank, then you're actually I think you're able to take candy from a baby right now.
Well, let's talk about 2022 for a second, because Guy and I, it's funny, like Guy, Danny, and myself, at least on the Tape podcast, we started in early 2021. There were so many things that we saw in that raging bull market in almost every risk asset class, obviously with rates, at zero and negative rates all over the world, that were really freaking us out, right? As
the four horsemen of the apocalypse.
It really was something. And, we were starting to take a little heat because they're like, why are you so bearish? And we'd be like, well, look under the hood, man. Like some of the stuff that's not acting well was alarming. The stuff that was acting well was alarming, right? Like it was the most speculative sort of stuff in a way. 2022 felt very orderly. It did make sense. The macro made sense. You know what I mean? The sector stuff made sense. Believing that China was going to lead us out eventually. You know what I mean? That was something that we were calling bullshit on and everything like that. It really was last year that there should have been further palpitations. There should have been further tests. There should have been one real test of the 2022 low. Do you know what I'm saying? And it never happened. And part of that had to do with what we're dealing with now in the first quarter of this year, which is this AI, secular trend that's being pulled forward a little bit. So talk to us about the orderly nature of 2022, what it was like losing money on that, but then catching 2023 really right into 2024.
So you think about the four horsemen of the apocalypse, right? With all due respect, Cathie Wood, meme stocks, SPACs,
right,
and Bitcoin.
Mm-hmm.
So the market was excessively orderly. Let's go shoot those guys, right? Then they'll go shoot the leaders. When they shot the leader, which was energy, if you remember, when they shot energy in February, March, early April of 2022, I felt with good accord that's at least one low, right? Then we had kind of the half-ass rally, and then we made the real low, which we called in October of 2022, and we said that was the start of the new cyclical bull market. Anyway, 2023, we had three very, very distinct tech rallies. January was the January effect. Let's buy all the shit that just got pounded, right? I mean, to be honest with you, I was so wrong in 2022. No one read my year ahead piece. Like, fucking, I'm not going to talk to Belski. He's always bullish, blah, blah, blah. Then all of a sudden, the first 2 weeks of January, tech stocks are rallying, and they're calling me like, Belski, why is the market up? So then we had the bank debacle, which I'm not going to call a crisis because it wasn't. A debacle. That was phase number 2.
Debacle's worse than a crisis?
No, less than.
Less than. It's less than a crisis.
Okay.
Debacle is just it's a crisis. Holy shit. Debacle.
Oh, got it. Okay. Sorry.
Thank you. And then trade number 3 was AI. Right? Then all of a sudden we gotta buy AI, we gotta buy tech. But remember too that I really believe that 2023 was one of these things where it was FOMO to the hilt, and then you had yields rally, meaning went up in October. People freaked out that it was just this big head fake move, And then the market took off again when yields reversed. That's what the whole big thing was. Then you had the melt up at the end of the year and a follow through into this year. All this is right now, I believe, on a near-term basis, is you have a Janet Jackson type market. What have you done for me lately? We're just short-term. See what I've done first quarter numbers. I think April is going to be a tougher month. I really do.
It's interesting. All right, so let's go 2022. I'm curious as to your thoughts on this. So 2022 made a lot of sense to me. And again, I get shit wrong all the time, but for whatever reason, I was in a good groove. I was bearish the entire year. Twice I was bullish. I'll tell you exactly when. It was June of that year when the VIX spiked up to about 35. And I think we came in and it was just universal, like the world's coming to an end. And that VIX suggested to me that short-term bottom had put in. The market then proceeded to rally 18%-ish. The same thing happened in October of that year. The VIX spiked to 34.5. Same type of thing. That was around the time people were saying China is uninvestable. The whole thing, that marked the short-term bottom. So I got both of those right. What I missed subsequently is pretty much everything since. What my question to you is, why doesn't volatility seem to find its way into the market? Like, what are your thoughts on that? Like, I have some thoughts that nobody really cares about at this point. I'm curious as to why the VIX is no longer
great question.
Interesting or a predictor of things. I mean, there seems to be a lid on this in a meaningful way.
We've been quote unquote dissers of the VIX for some time.
Yeah,
because
correctly then.
Thank you. Because I think too many people look at it. What we look at in terms of volatility is we look at the standard deviation of returns, right? So when you have this dispersion begin to increase, it tells us that we're becoming more stock picking. But when everyone is very correlated and standard deviations fall and the market's going down, that to us is volatility is increasing, and that trend is most likely close to reversing. That's what we've looked at. So we can look at daily, weekly, quarterly price performance standard deviations. That's been a better clue for volatility with respect to making that call relative to the VIX.
All right, let's talk about the S&P 500. You just mentioned that you're near-term bearish. You've been bullish for a long time. You called the low in late 2022. You got the cycles right in 2023, the sort of things that acted as, tailwinds to the stock market. But, one of the biggest tailwinds was really that mid-December Fed presser, right? When folks were convinced there was going to be 6 rate cuts this year. Okay, here we are. It's Thursday into the close. We have an S&P that is just raging. It's up 1%. The NASDAQ is up more than 1.7% or something like that. So they're basically back at their all-time highs. The NASDAQ's up 8.5% in the years, or NASDAQ 100's up a little less than that. And then the S&P is up, about 8%. Okay, so here we are. We're in the last month of Q1 here. And you just said April is going to be a bit more difficult, but rate cuts are basically half of what they were coming into this year as far as expectations are concerned. So what do you do here, man? Like, because it really seems kind of hard. I just pulled up a chart. I know a lot of our listeners are sick of hearing this one, but Nvidia is up 100% from its January lows, okay, in 2 months. That's $1.15 trillion in market cap, and just look across the semi space and everything like that. There's a lot of insanity that's gone on here, at least as it relates to our careers. Like, help us make this. How is this going to pause without turning into something more than a pause? And it brings me back to mid-July of last year, and over 2 months, we sold off 11, 12% or so from there.
Like my therapist says, lots to unpack there. So let's unpack.
So Guy hates multi-pronged questions. That was just a narrative. Like, that was just a big old-fashioned thing or whatever. Go ahead, do it. No, but that's fine. Do it.
For anybody that wants to be, and I'm not suggesting by any stretch of the imagination that I'm good at this medium.
You're not bad.
I'm not bad. But one thing you'll notice from me is, and this drives me crazy, and all different, whatever it's news, sports, whatever it is. I have a 2-part question for you, Mr. President. No, question number 1, and question number. By the time you get to question number 2, they already forgot what question number 1 was. So they're answering 2, and then they say, and remind me again what 1 was. So I've learned just to ask one question.
You're good, dude. You're good at it.
Anyway, that's
what I do.
The more you know.
Yeah, but what I do is slightly different. We're not. This is not just a Q&A.
No, it's a conversation.
We are very fortunate to have Brian Belski here with us, joining the conversation. I gave you a whole bunch of things that I believe and a bunch of stats, and then I ended it, Guy, with a question.
I understand.
So I'm just saying.
Let's talk Nvidia first.
It's a stylistic thing. Sorry, Brian.
I mean, this isn't like smart lists where they don't even let the other fucking guy talk.
No.
Right?
This is your rodeo.
Oh
listen,
my god!
I do hear that, but they're kind of funny. Guy just has done probably 500 podcasts in 3.5 years. It's Jason Bateman, Will Arnett, and Sean Hayes. It's one of the top performing podcasts. Yeah. But my point is, those guys love hearing themselves talk. They also make fun of each other about their own asking of the questions and this and that, whatever. All right, so it's not smart list.
On Nvidia, right? We've owned the stock for 7 years.
That's unbelievable.
Lucky, by the way.
So
let me just say lucky.
Stop for 1 second. That's incredible. There was a period of time, I want to say it was October of 22. I might be wrong. When you couldn't give that stock away to anybody. It was trading $108.
Yep.
It had cascaded lower. Even the most ardent bulls were saying, you got to remember that scene in Wall Street, you got to take the money and run in BST type of thing. Yeah. I mean, it was, so the fact that you stuck with it is remarkable. Anyway, please continue.
So we have the very good fortune of running 10 SMA accounts, separately managed accounts for our BMO Wealth Management clients in the US and Canada. I had a template email, in 2022 about Nvidia and about Shopify. Mm-hmm. The emails that we would get as a group, why the hell are you not selling these two stocks? Ready to go, So what we've done in this craziness, because I do think the market's frothy here.
Right.
There's nothing wrong in portfolio management to take a little off the table and still own the stock. Mm-hmm. We've owned the stock for 7 years. We love it. It's one of our top 25 favorite names, So let's stay with it. Let's be a little bit more constructive. On the market in general, we said in November of 2022, nobody read the report because everybody hated us because we were wrong in 2022, that a new bull market started in October 22. So you go October 22 to October 23, that's year one. Now we're into year two, right? October 23 into now. Mm-hmm. By now, the market, if you look at the last 13 bull markets, the market should have pulled back in the fourth month. It traditionally pulls back an average of 9.5%. And then after the pullback, it goes up an average of 14.5%. Now, let's be clear. There's nothing average or normal about the shit that's going on right now. However, it really bothers me that when we put out our year ahead piece in November, we said 5,100 base case, 5,500 bull case. Mm-hmm. Now everyone's chasing back to where we are. Yeah. It scares me that everyone is where we were a number of months ago. So from a sentiment perspective, that bothers me. Number two, on the bothering and the sentiment side of things, you have many of these strategists that are actually talking like they're bullish, but they're actually talking bearish. They don't believe what they're saying. Right. They have transitioned from their process and discipline, or as they say in Canada, process. Like, even though, earnings and PE don't fit our target, this is a momentum market. I would be willing to bet that if you Google search momentum, momentum this year is to what recession was last year.
That's
Everyone's talking fucking momentum.
We had a conversation about that because John Butters, who does amazing work for FactSet, his note this week was talking about the number of times recession was mentioned. Let me ask you this, because I'm always fascinated by this, and I'm just curious as to your process.
Whatever you want to say.
No, I don't.
Process.
You're from Minnesota. You're practically Canadian.
Yeah, I know. They should just annex Minnesota.
Canada should
just
annex Minnesota. By the way, why did the North Stars, if you think about hockey in the United States, why would the Minnesota North Stars ever, what? I understand there's a team there now. It's not the point.
Minnesota Wild.
They left. Minnesota left. It's crazy.
And the next year they won the Cup in Dallas because there was a guy, Norm Green, was trying to hold the government of Minnesota hostage by building a new stadium.
That actually upset me.
And they basically said, F you. They go down to Dallas, they win the Cup, and to this day, when you go to a Minnesota Wild game, when the Stars hit the ice, they boo them.
Well, they should. It's the same when the Browns left clear. I mean, seriously?
Yeah.
How does that happen? Anyway,
the Seahawks or the Sonics are going back to Seattle.
They should. Yeah. They should have never left either.
Well, they're not the Sonics, though. They're going to get
the Thunder, right?
Team. Yeah.
Oh, yeah, whatever.
All right, so here you go. Process.
Yeah.
Math. This is a lot of math, right? So do you come up with an S&P target and then back into it with a multiple and earnings? Or do you say, you know what, I'm convinced we're going to earn $250 this year. This is the right multiple for those earnings, which gets me. How does that work? I'm curious.
So we run a price target and an earnings target, okay? So for our price target, we run a good old-fashioned dividend discount model. We run a PE regression model, and we do a macro model. And then we use the median of all three. We do the same thing with respect to earnings, but we use a bottoms-up, top-down in a longer-term macro regression. Shocker, the macro work has been negative for a while. So we have to kind of, downgrade that a little bit from the weightings of it. But we're much more mathematical than that. And the thing about market targets, to me, it's an academic practice.
Right.
And I've been long against, you should never run a portfolio based on academics. You should run a portfolio based on fundamental stock picking. So just like we become too macro.
So you're not solving for something. Each number is found on its own.
Correct.
And that gets you to an outcome.
Correct.
You were one of the people that were saying for a long time that the United States equity market deserved a premium multiple for a myriad of different reasons, which didn't make a whole lot of sense to people like me. But as it turned out, it was exactly right for all the reasons you stated. Do we still deserve, and we can argue whether or not we should be trading higher, but we are trading historically at a premium multiple to where history suggests the norm is. So speak to that. I mean, is this the right multiple Is this the right multiple in this environment?
Multiple can go up a little bit more, I think. But the key thing is that earnings are going to go up as well. So, I mean, if you're going to a 20 to 23 multiple, that's not expensive, especially, I don't want to say the best house in a bad neighborhood. There is no fucking other neighborhood, right? Because what does Europe make aside from a couple countries, right? Japan has been reinflating. That's fantastic. China's a complete shit show. We've been telling people to stay away from China for a decade. Okay. Now, I do believe there is going to be some new emerging market. I don't know what it is. I think we'll find that out 5, 6, 7 years from now. But in between that time, I think coming out of this craziness of zero interest rates, which, oh, by the way, was not normal.
No.
Okay. I think we're heading back into normal. And this is year 2 of the normalization, which I think is going to last 5 to 7 years. What's normal? 10 to 13% earnings growth, 10 to 13% CAGR on the market. We're going to have some bull cycles, we'll have some bear cycles. But I do think that we can coexist in a period where interest rates are 3 to 5%, and we're going to see that type of performance from stocks.
Well, it's funny though, 3 to 5%, you're talking the 10-year, right? And so, that move in the 10-year from 4 to 5% did a number on the stock market, last September, right? And so here we are right now, we have 4.1 in the 10-year. We have a U.S. dollar index that's come off hard. I mean, no one's really talking about the dollar move of late here. So if you're thinking about, and I'm going to say something to get Guy all tweaked right now, a sort of Goldilocks situation here, like I get it. That is supportive of equities right now. And you just said you said it kind of emphatically, earnings are going higher,
Earnings are going higher. I think financial earnings are way understated. You're going to have tech earnings that are good. Healthcare is fine, but I think when anybody's so focused on Ozempic, that just scares the shit out of me a little bit. So I think you need.
Why you think it's too narrow? That like so you have two stocks now. Just Novo's up 10% as we're speaking.
And Lilly,
well, but today at an all-time high. So the two of them are like $1.3 trillion in market cap.
Lilly's the largest company in the S&P 500 healthcare sector. I cannot believe that. I mean, that's amazing.
It's almost $800 billion. I mean, it's approaching $1 trillion company, which people think is actually, it's going to surpass that given their earnings profile over the next 3.5 years. So, that would make you think about it. I mean, I think prior to that, not to get into this rabbit hole, but prior to that, I think $500 billion was sort of like that was the line in the sand.
Yeah.
And now it seemed two of these companies have just ratcheted right through. Anyway, please continue.
No, so I think we're going to have better earnings. It's not a straight line, but I think we need to kind of wash this out a little bit. To me, this reminds me of the way I like to explain it. It's kind of like 1983 meets 1995. So think of Madonna, Borderline, meets Nirvana.
By the way,
Lithium.
That's the only Madonna song, honestly. I don't have any Madonna on my 875 song Spotify playlist. But if I were to have one, it would be Borderline. Please continue.
So what do you give a Borderline personality? You give them lithium. See how you remember that? Goldilocks. Now, if you remember 1995, we had a commercial real estate crisis. The Fed was raising rates. And then Greenspan pivoted hard in January, Goldilocks. And then we had irrational exuberance. Oh, by the way, that had nothing to do with tech stocks. That had everything to do with Coca-Cola and Gillette and Procter & Gamble, the consumer staples names trading at 40, 50 times earnings. Then you had, people think about the 90s like tech, like the 70s disco. Disco was only around for a couple of years.
Thank God.
Right, exactly. So tech was really only around for 2 or 3 years. But then it was really driving things if you think about it. So I think we're heading into this. We're already in this Goldilocks period. which U.S. stocks can trade at a premium. But I think Canadian names are coming along for the ride too because of the cross-border proximity and the business relationship and where assets kind of flow. I just don't think there's any reason to be anywhere else.
All right, you mentioned a bunch of sectors, and I think let's spend a minute on financials. You just said basically you think earnings expectations are way too low there. Yep. We're coming on the 1-year anniversary of not the crisis, but the debacle. We just had this NYCB thing. I mean, like, what are your thoughts here? Because again, does the rate move then? Like, if we were to have rates come in, does it help a lot of that? What we've seen, some of the trepidation in and around these held to maturity mark-to-market portfolios.
No, I think it does. And our whole theme has been, we talked about a year ago, like scale. That's why like the money center banks, the asset managers, and the broker dealers. So how are banks going to compete going forward? Scale. How do they get scale? M&A. We're going to see massive consolidation, and I think regulation is going to come off. You have to prepare for that now. By the time they start talking about it, it's going to be too late. Now, I really think that we're in one of these periods where the really big will do well and the really small will do well. And meaning like a small mid-cap bank that has a very clean balance sheet and great management teams and a good business proposal relative to like a Bank of America. We like Citigroup because it's contrarian. Our most broad positions are JP Morgan and Bank of America, but we've been selling a little JP Morgan because everyone's in love with Jamie Dimon. So let's take from Jamie and give to Jane a little bit. That's the way I think about it.
By the way, you're right, and Citi's had a pretty decent run over the last couple months, and it still trades at a pretty steep discount to tangible book. And I'm not suggesting it should go back there because I think tangible book, I don't know, I want to say, well, my point is it should be trading a lot closer to it than it currently is. So you mentioned Citi. Does it still have room to the upside?
Oh, yeah, I think so. And I think it's massively underowned by institutions and still very, very not loved. But I think the next play is going to be some of these regionals. Mm-hmm. That's going to be look at the XLF making new highs. But I think it's not going to be all regionals. It's going to be a mixture kind of the most powerful and the stinkiest, quite frankly, because the stinkiest are the ones that are going to get bought.
July 12th, 1979, Dan, does it mean anything to you?
Nope.
Were you born?
I was 72.
72, so you were around.
I'm 7.
Mean anything to you, Brian Belski?
Was that Comiskey Park?
He's so good. I knew he would know this because you brought up disco, and it was on that night that Chicago White Sox, the Bill Veeck Chicago White Sox, they had this great idea, disco demolition night, right? Yeah. There was a doubleheader. The White Sox were playing the Tigers. Between games, you bring all your shitty disco albums, and they were going to blow them up in the middle of the field. Well, it was so successful that they had to forfeit game 2 to the Tigers. Here's my question. What could blow up, like that segue, what could blow up the thesis that you've had correct? Like, what concerns you about all that? Other than the things you mentioned, that now people are sort of coming around to your way of thinking. What sort of concerns you out there?
I think the big thing is inflation. If inflation really starts to accelerate again, we're wrong.
Are you seeing signs of that?
No.
Even with, it's interesting because lately there seems to be a reacceleration of some of these underlying things, which again are manifesting themselves in numbers slightly, but you're not concerned that it's going to have that sort of like what we saw in the early 1970s when we thought we basically snuffed it out, only to have it coming back like a champ.
Yeah, I think on the 70s, people haven't done their homework because we had an administration where President Nixon was actually trying to cut wages. Mm-hmm. You go back and look at that, where we have a current administration that wants to pay and give everything away for free. We had an oil embargo. We had that double dip recession. We were still trying to get out of Vietnam and pay for Vietnam. And that was a bigger problem. There was a lot of different things going on in the 70s. I think, guys, that if inflation stays stickier and higher like it is now, I'm still befuddled on why anybody actually thought we were going to see a rate cut in March. I don't understand how it was. And you know what it was? You talked about why you were wrong. Think about this. Everybody and their mother, brother, sister, cousin, uncle were following Fed funds future. Mm-hmm. We're so focused on it. Investing's not about following the Fed. Investing's about buying really good companies at the right price, period. And so I think too many people, like they were following the VIX, too many people were following Fed funds futures. Now, if we see inflation stay kind of where it's at, then the people that are positioned for lower rates, all of a sudden you got a 21, 22 multiple on right now earnings are 240, 245. Our number's 250 for the year. Holy shit, they're going to say rates, the 10-year treasury is not rallying. They'll sell. I think that's going to be at least somewhat of a near-term signal for people to get out of the market.
I just saw today, I think debt service on the U.S. debt is now $1 trillion. It's a staggering number. So we're about $35 trillion-ish or so. This over the next 11 months, and please correct me if I'm wrong, but I think we need to basically $9 trillion of paper needs to basically be refinanced on top of another $1 trillion or so of deficit. So let's just call it $9.5–10 trillion. One of the reasons, and I may be incorrect on this, but I still think rates have a chance to go higher is because I think it's just be a supply demand thing. I think we'll be able to, I'm not saying the U.S. is going to, it's not my point, but the market is going to demand a higher rate of interest to buy that debt, which by definition should mean rates go up. Thoughts on that?
I think you're right, and that's why we threw out this 3 to 5%. I mean, you looked at me like 5%. Fuck. I mean, 5% is the average 10-year treasury the last 80 years. So, I mean, let's start.
But it depends where inflation's going, right?
Well, exactly. But if we start to see this inflation kind of stay there, I think rates could be around in this area for longer than you think. I really do.
So then what is the risk of stagflation, I guess? You know what I'm saying? So like if that becomes embedded in the economy, right? And it's not at a level that you're worried about the sort of spike that we had, let's say in 2021 or anything like that, but it becomes embedded in just, in our everyday lives, and rates stay higher, sooner or later, that will weigh on risk assets dramatically.
I think we need to see a significant spike in inflation to make stagflation a reality, and then we kind of do something.
Well, all right, so what would be a CPI or a PCE print that would freak out equities at 5,100?
5%?
Yeah. Well, but it won't happen like that. No. It'll be moving towards it.
Yeah. So here's I think we all sort of have interesting, differing views on inflation. What are your thoughts on the employment picture? Understanding that, I mean, we're still significantly below 4%.
Yep.
I mean, tight labor market, I get it. Seemingly, there's some states that have been showing signs of weakness. California, which I still think would be the 5th largest economy in the world if it were a country, their unemployment rate is north of 5% now. They typically lead the country by 6 to 9 months. You can say, you know what, much different now. California has its own issues. There are a number of things going on. I guess my question to you is there a concern that the unemployment rate could start stair-stepping higher in a way that nobody sees coming?
That's been the argument, which has kept people bearish, right? But I think to really get have a situation, for employment to really matter, to be negative, you got to see 7 or 8% unemployment. Yeah, I don't think we're going there anytime soon.
I don't think we're going there. So
to be a real issue now, will 5-6% scare the shit out of everybody?
Yes.
I think that would, but to have a real fundamental issue, then we're talking 7-8%.
So it's interesting.
But then those
numbers I agree with. By the way,
but then you have to ask yourself this: so what happens if we get a 5-6% unemployment? What's the Fed going to do? They're going to cut rates, and then what's the 14-year-old hedge fund manager going to do? They're going to buy stocks.
Right. If in fact that inflation if that thing is sort of moderating, and then you would say, well, by definition, if the unemployment rate starts going higher, inflation should start to move lower. I mean, there's so many. These are the things that, you say, when are you lying thinking about? This is the shit that I think about.
I thought you were going to go. So on Mondays on the Tape podcast with our mutually great friend, Liz Young, we had this conversation about services inflation and how much wages make up of that. Okay. And so, we just kind of went back and forth about the unemployment rate. That's one thing. But let's go back to China and then let's talk about wages. Okay. So for a second here, think about what's going on there. Just how disappointing their economic growth is, how disappointing the reaction in their markets are to whatever stimulus that they have. When you think about the deflationary readings that we've seen over there for a year, you think about that youth unemployment rate, which is massive. And then you think about this narrative about their really horrible demographics. If you look out 20 years or so, they're going to be well below 1 billion population. And lots of folks that I read, and maybe this is kind of like tin hat sort of stuff or whatever, we're like, China's no longer should not be too worried about them anymore. But what I worry about in the near term is that maybe there's not enough focus on them exporting their deflation, them dumping on the U.S. cheap goods for that matter, which would cause lots of companies, let's just say, price wars like we've seen in the EV space, right? Then you start cutting jobs, to Guy's point. Then you see downward pressure on services inflation and on goods inflation. And maybe we get back to the pre-pandemic times where we were worried about getting inflation up to 2%.
Yeah, the China question's a kerfuffle, right? Because for everything you said, but you missed I think one of the biggest things from a cultural perspective, they don't spend money.
Mm-hmm. Yeah.
Right. So
but they did, it's funny when they were moving from the farms to these cities, they were buying iPhones, right? They were buying our crap. They were buying lattes at Starbucks. They were buying Nikes, LeBrons, and stuff like that.
That was definitely a narrative.
Like that was
there.
a thing. And look at how those stocks act. You see how Starbucks and Nike act right now, and Tesla? They act horrible. Mm-hmm. And in China was a huge part of their expected future growth.
Yeah, it's going to be interesting to see as they transition from this industrial-based economy, they built all this stuff, to continuing to maybe not buy one iPhone, but a bunch of different iPhones. And then now we have the EV situation with them potentially bringing cars over here in the cheaper good. That is a potential issue. Whether or not they can actually do that with all the other demographic issues that they have in terms of their unemployment and aging demographics and all of that, and higher wages as well. So I still think they've got more work to do relative to them causing this type of deflationary.
What is the one thing we should be watching that you think about that you haven't really mentioned out there that it's sort of on your horizon, on your sort of radar screen, that not a lot? I know you said earlier, when everybody starts coming around the way you think, it scares you, and I'm wired the same way. But what are you thinking about that you're sort of holding back on, sort of stewing on, that you're sort of looking at over the next year or so?
I've been a long-term tech bull, and is there going to be something that helps really break down the tech sector a little bit more? Because when you have a sector, if you add in communication services, more than 30% of the market, right? And I always worry about that, 40% of the market. And we, in the fourth quarter, started talking about doing our standard deviation work. We were starting to see dispersion already in the Magnificent Seven. Now that's obviously bearing fruit. So I think for me to worry, I think we need to see more of a breakdown in real fundamental earnings from some of these names. That would be something that not many people are talking about. I mean, obviously, we're in the AI revolution. We're really early. To me, this has no correlation to the late 90s, nothing. Because these are like real products relative to, billable people walking down the street when we're looking at
they're clearly real products. But I guess the question for this year, 2024, Brian, will be whether they basically can be, monetized. You know what I mean? If they're consumer facing, whether it's Microsoft's Copilot, whether it's whatever Salesforce is going to integrate, you know what I mean? Like the jury's kind of still out on that. And, we were quoting this earlier in the week, when you look at Q4 earnings, that the Mag 7, X probably Tesla, because I think their earnings were down year over year, had 60% earnings growth year over year. The rest of the 493 were down 1.5% or so. So again, and we are starting to see this. I mean, look at the way Google has been acting and the way that they're missing numbers the last 2 quarters. Obviously, Tesla is an absolute train wreck. And then, kind of throw in, like take your pick. I mean, like Apple is, a low single digit grower. So if China is 20% of their sales and the Chinese, what did you say, don't spend anymore? You know what I mean? Like, I don't know, man, that dispersion could start to broaden out. And I'm not sure you waiting for the financial sector or the energy sector or the health care sector to make up whatever slack. You know what I mean? Like, that's where I am. And I don't do the quantitative work that you do. I don't I'm just trying to throw, because we have the benefit, Guy and myself, of talking to lots of great strategists and hearing all these sorts of different views, and we know how rigorous you are. But I'm just trying to push back. You've been right, but right now you sound a little like, okay, let's take a little of the froth off, because
let's
a lot of stuff has been pulled forward.
It would not be a bad thing, guys, if tech rolls over, because we need to see broader participation from everything else. And we for one, our theme for 2024 was a playoff of Will Ferrell and Semi-Pro, Everybody Love Everybody, meaning we actually have that in the report. Everybody love everybody. Got it through compliance. I think you should own a little bit of everything: small cap, mid cap, large cap, growth, value, and not be so. I think we're so focused on growth, and then you can say all these stories like growth. you buy growth when growth is scarce, blah, blah, blah. And people are believing their own bullshit, but it's easy when the stocks are going up. I think to have tech roll over a little bit and give performance to everything else would be actually quite healthy and normal, because it's not normal that they are the way they are right now.
All right, one last question, because you and I first met in the mid-aughts. I was at Merrill Lynch. You were at Merrill Lynch. That's the 2000s guy. Okay. And you were part of a prolific strategy team back then. You were David Rosenberg, Richard Bernstein. Savita Subramanian was just a young pup on one of those teams. And you were head of U.S. equity strat? Is that correct?
Sector strategy.
And sector strat. Talk to us about what you learned. And again, you left Merrill in early 2009, I guess, towards the buy, so after Bank of America bought them. And
I was part of the bloody incursion. The day that John Thane got axed, I got axed as well.
Okay. I mean, there was a lot of mushing those two businesses together and everything like that. But what were some of the big takeaways, you would just say, being a part of a team like that? You guys had a great call throughout. Listen, a little early. Can we all agree on that as far as that? But you guys had that call right. You navigated the waters correctly. You guys have all gone on to have amazing careers since then, too. Talk to me a little bit about that, because, again, I think a lot of our listeners probably recall you guys in that team.
Well, you never want to take on David Rosenberg with respect to any kind of macro data. And, he's known to be a perma bear, but he's voracious in terms of what he thinks about and what he knows about macro. And then you have Savita, who took over the quant product from Rich, who became chief investment strategist. And although Rich was still the call on the U.S. market, I did all the sectors and talked about how to invest, actually. And so to have that type of team together was amazing. And remember, too, that was when we really were the thundering herd. And we obviously did a lot with private wealth, because part of my job was I managed the client profile portfolios, which were known for some time as the Chuck Cloud portfolios. Then they got handed to me. Then we also had a core portfolio and an international portfolio. So I would go around to all the branches. But the coolest thing about that was that I could only buy Merrill Lynch followed equities. So I was constantly in analyst's office. And I learned a little trick that you always buy neutral rated companies when the analysts was starting to up their numbers, because they eventually had to change their rating to outperform. So we learned how to play that game a little bit, but it was an amazing experience. And I'll say this is that, this is my 35th year on Wall Street. I started in the business when I was 8 years old, obviously. But
see that one?
My 4 years at Merrill were people still remember me from Merrill because of the strength of the brand and everything like that. But, we had people think I'm this, perma bull, but I believe this might be right, that I was the very first strategist in the world to go to a sell on financials. And I did so in mid-August of 2007. And part of my job was coming up with ideas, right? So we published this note on a Friday, and I was speaking at the Canadian Traders Convention in Vancouver. So I had to get up at 3:30 in the morning for the 4 a.m. meeting, 7 a.m. in New York. And I let off the morning call with, we're making a move in U.S. strategy. We're going to a sell in financials and a buy in tech, right? An hour and a half later, the Fed opened up the window, right? The market was up 2%, financials up 4%. So I look like a complete ass, right? I am wrong. But this was when financials had nothing to do with interest rates or yield, it had everything to do with credit spreads. And so I had this chart in my report, and the director of research calls me and she goes, what hell is going on? And I said, look at page 3, exhibit 7. And she looked at it and she goes, I'm with you. And so that I was early. Well, the Merrill thing, just to go back to the Merrill thing, because I came from Piper Jaffray. So I was chief strategist at Piper Jaffray, and then I came to Merrill. And I originally had the job as head of wealth management strategy. And then when you're in meetings, right, with Rich Bernstein and Savita and Marianne Bartels and Rosenberg, you better have something to say, because you better bring your A game. Because you can't be the chief strategist at Piper and just people are going to believe you, man. You better get your shit straight. So that only makes you better, I think.
We mentioned a lot here. So Brian mentioned the thundering herd. That, of course, is the Marshall University football team.
But Merrill Lynch was, their tagline was, be bullish.
we are bullish on America. Merrill Lynch is bullish.
Be bullish, yes, of course.
You know, Guy, we say this all the time. Or did I cut you off? Were you going to go somewhere?
I was.
You know, every once in a while, and we're not going to name any names, when we get done with a podcast, we say, you know, if you ever want a mic and do this like more regularly, we say that. We're not going to say who we said that to. I'm going to say that right here. This guy's a podcaster. I mean, this guy's
he knows how to do it. He's got chops.
You see me throw up that Comiskey thing?
I knew. No, can I tell you something? I knew you would know that. Yeah. I didn't, and I'm not. I knew because that's a high compliment for me. Like I know you know. Like you have what your sort of brain is wired.
Well, you know what we're gonna have to do? We can't wait until next March to have Brian back on. We're gonna have to do something during baseball season.
Yeah,
would be really nice.
Well, soon to be world champion Minnesota Twins.
Yeah. Well, let's not get carried away. I mean,
let's do it.
What are you, nuts?
Let's do it again. This was fun, man. It was.
By the way, Randy Moss went to Marshall. His high school backcourt mate was Jason Williams. Now, if you want to watch something, we'll put it in the show notes. Jason Williams was a freak on the basketball court. Just saying. Randy Moss, obviously a freak on the football field. You're a freak, and I'm pointing at Brian Belski, in terms of strategy. So congratulations. It's like Malkovich said, all night long, check, this son of a bitch. But you know what? You were right. Malkovich was right. Pay the man his money. Well, we should pay the respect that Brian Belski deserves, Dan Nathan.
Thanks, Brian. Thank you
so much for having us. We appreciate it.
Thanks, man.